Good afternoon, everybody, and thank you so much for joining us here at the African Reform Movement channel. We discuss everything African reform with an emphasis on Ghana. As always, I'm your host, Uche, and we have, as ever, Dr. Nee, our distinguished host, who's going to be sharing more of his wisdom with us today. So I always say to the new people, so if you're new here, welcome. Thank you for joining us. Just to make you aware, Dr. Nee has a number of social media platforms which you can communicate with him on. They're all listed there below. These will also be found in his description box. Don't worry if you haven't got it to hand, a pen or paper to write it down right now. They're all in his description box. And he also writes a number of books. He has his own book nook store. And some of the books he's written are Tete Kwashi, The Star to Follow, Fair State Charter for Africa, Weep Not Africa, and The Fifth Republic. Just want to do a quick poll. If you're not new here and you've been visiting the channel for a while, please drop us a line and let us know if you've purchased any of these books and what your thoughts are, how they've changed the way you think, etc., etc. Okay. So today we have another topic with regards to the state of the country. Unfortunately, we just had a little bit of a conversation about that before. I'll say in every African country, there's something going on. It's not just in Africa, but as we're focused on Africa, there's something going on everywhere in our continent at the moment. So Dr. Nee is talking about interest rates and the moving parts of an economy. Okay, so for all of you who are economists, all of you who understand finances and so forth, this is one for you. So please do tune in. And any questions you have, please don't feel afraid to put them in the chat box here. I will ask them to Dr. Nee so I can answer your burning questions at the end of this segment. Okay, Dr. Nee, over to you.
Thank you very much, Uche, and thanks very much for everyone who has made time to be with us this morning in Ghana. We are moving very close to spring now in Australia. 1st of September is spring. So it's cold, but not too bad. Today we are talking about a very important thing, interest rates. Very, very important. As far as I'm concerned, it's the most important macroeconomic tool in any economy. I'll try and be very simple, basic, straight to the point, and probably try and finish it in good time so that people can ask questions and make comments to make the interaction more both ways, more of a dialogue than a monologue. Interest rate basically is let me put it this way, the interest we are talking about, we call it in Australia cash rate. I think they call it in Ghana policy rate, and Bloomberg calls it benchmark interest rate. They call it benchmark because all other interest rates in the country depend on that. All other interest rates depend on the basic interest rate. But the one we're talking about is the rate at which the central bank loans money to other banks. So if other banks go to the central bank to borrow money, the interest rate they pay on the money they borrow is what you're talking about, which we call it cash rate in Australia, and in Ghana they call it policy rate. Now, in most economies, in civilized economies, the implementation of this interest rate is very important for the simple reason that it is the benchmark rate for everything in the country. So if you do it and get it wrong, it affects every aspect of the economy of the country. Today we are talking about interest rates and the moving parts of an economy. The economy is not just one bucket, different buckets, different things happen at the same time. And the interest rate is supposed to be there to regulate and manipulate and intervene when necessary to give the best outcome. Because the interaction between the various macroeconomic variables are very, very unpredictable, interest rates are always or almost always implemented very cautiously. Can we please have the first slide? So interest, cash, policy rate central bank borrows to other banks, gradual to peak yielding and breaking points. Okay, now the reason why I've added this gradual is implemented or is increased or decreased gradually so that the bank can monitor and pick up the yielding and the breaking points in the economy. As we go through this series, we understand what I mean by the yield and the breaking point. Every material, if you have done a bit of material physics, you know that every material has got an elastic limit within which you can play with weights, within which you can add weight, you can add loads, and still, like like you have an elastic band, you can stretch it up to a certain extent. When you release it, it bounces back to original status. When you stretch it a bit far, you realize that it may bounce back, but it doesn't come to the original point. Then you are getting to the yielding point. And at a certain point, when you stretch it, it breaks completely. That's the breaking point. Now, that's the way interest rates are played around with. You do it gradually so that whilst you are, if for instance, your aim of increasing interest rate is to restrain inflation, you should know that it doesn't affect only inflation. It affects exchange rate. It affects the general economy. It affects people's choices and what they do with their money. So you increase it in cautiously whilst you are looking at whether really is really bringing inflation under control and it's not affecting other aspects of the economy. That's the way it's done properly. And the moment you realize that, look, we are not succeeding with the inflation, but other parts of the economy are hurting, you stop there. So it's always implemented slowly and cautiously whilst monitoring all the variables in the macroeconomy. Ghana, on Monday or so, the central bank, the monetary policy committee of the central bank had a meeting and they decided to increase the policy rates, the benchmark rate by 3% from 19 to 22. When Bloomberg first reported it, they said this is the highest interest rate in 20 years. Today, they've changed. They said this is the highest hike in interest rate on record. And I wrote an article, I think yesterday or the day before, in which I said that Bloomberg forgot to say one thing. This year, of the 202 countries in the world, no country has increased its interest rate one single hike by 3%. It tells you something is fundamentally wrong. And according to the Bank of Ghana report, they are doing this to try and help the city, stabilize the city. We'll see whether this is the right way of stabilizing the city, because all interest rates in Australia, we have had 4 interest rate hikes since May. And they've never increased it at any particular time by more than 0.5. After 4 increases, the total increase in interest rate is 1.85. In Ghana, one single increase to 3%. Something is very, very wrong. Now, when you do that, you give those who understand how the economy works, you give them the impression that 1, you don't know what you are doing, 2, you're in a panic mode. And after they increase the interest by 3%, the city has fallen by 12%. So it's not working. And it's not going to work. Okay? It's not going to work. All right. So let's see. Next slide, please. Moving parts of the economy. All right. There are various moving parts, but I'll just look at these 4. One moving part of the economy is inflation, exchange rate, the domestic economy, and personal choices. Next slide. Inflation. Okay. So how does interest rate affect inflation? We are talking about because we are talking about Ghana case, we are talking about increase in interest rate. Okay, how does increase in interest rate affect inflation? Now, when you increase the interest rate, technically you are reducing people's what disposable income. Because if somebody pays $500 a month on his car, or is paid $500 or $1,000 a month on his house, a mortgage house, and you increase the interest rate, the person is going to pay more. When the person pays more with the same salary, it means that he's got less disposable income. His income after paying the mortgage has reduced as a result of the increase in interest rate. Okay, so this is another part of the economy that if you are thinking of chasing the currency, you must be thinking about that. How much can I increase the interest rate that will not actually hit people's pocket too much? Especially when we're talking about inflation in a country like Ghana, where we're in hyperinflation mode as we speak. Okay. So now, when you increase interest rate, you reduce income, and then demand for goods will also reduce. Now, when demand for goods reduce, obviously it affects inflation, and inflation comes down because inflation comes with higher demand, and that's how increase in interest rate reduces inflation. It does so through less income and less demand for commodity. But it only works where there are no other inflationary pressures in the system. For instance, you cannot increase interest rates and print more money into the system that adds more inflationary pressure to the system and think that inflation is going to be controlled. The reason why inflation cannot be controlled with interest rate in country like Ghana is because we are always printing money. The reason why inflation works in a country like Australia to restrain interest rates, increase in interest rate works in the country like Australia to restrain inflation is because government doesn't print money into the system that has not been captured in the budget. So the inflation, and then when they're increasing salaries in Australia, it's usually inflation plus one. Nobody gets up and say, no, we want 40% increase in salary or 30% because all these things are inflationary. You can increase the interest rate, but when you yield to market demand, 40% increase in salaries, 30% increase in salary, you are adding inflation price to the system, and the increase in interest rate will not work. Okay. Next slide. So this is one part of the economy that interest rate affects. If you are thinking of chasing the exchange rate, you have to know the effect it's going to have on inflation. The effect it's going to have on mortgages. The effect you're going to have on all these things that are also part of the economy. And if there is no way that the increase in interest rate is going to have the desired result concerning the exchange rate, then you are punishing the economy, like in Ghana's case. Next slide. Okay, exchange rate. The reason why increase interest rate improves exchange rate is because people tend to move their money into an economy with a high interest rate because they get more returns on their investment. So because they get increased returns on their investment, they move their money there, they get more money because if you have two economies, one interest rate is 2%, the other interest rate is 15% or 10%. Everybody will move his money to where the interest rate is 15% because it's going to have more returns on that money. That's the reason why when you increase interest rate, there's a possibility that the local currency may improve because more money moves in because of increased returns. But that's the most simplistic way of looking at it. There are many factors that affect the exchange rate. That's why even countries like Australia, half of the time, top economies get it wrong when they forecast how the Australian dollar is going to move against the US dollar. They don't get it right all the time because complex interactions between different factors. And I can tell you some of them. One, balance of payment. Now, there are two parts of balance of payment. We have current account and capital account. Current account deals with the actual balance between imports and exports. So when your exports, receipts, money from your export exceed money from your import, you have positive current account. Okay? And capital account refers to actual investment that is made, not trading in goods and services, but actual investment that is made in an economy. So when actual investment, when capital account is zero, balance of payment becomes equal to current account. In a country with poor foreign direct investment like Ghana, balance of payment approaches current account. Now, we are talking about the fundamental. Okay? Balance of payment. Difference between exports and imports, receipts. So if your exports exceed your import, you have positive balance of payment. Your currency becomes more valuable because people need your produce than you need the produce of the rest of the world. This is the fundamental principle, no interest rate. So if your balance of payment is very negative, if the balance of payment is very negative, then it doesn't matter how high you raise your interest rate, it's not going to make a dent because your fundamental is wrong. You need foreign currency because your imports far exceed your exports. Fundamental. Then the next one is terms of trade. Now, terms of trade is similar to balance of payment, except that this is a ratio. It's a ratio between the money you get from export, divided by the money you get from imports. So again, if your terms of trade is greater than 1, then it means that you get more money from exports than you lose through imports. And for that reason, your currency becomes stronger. That's what happened in the mid-70s when the Nigerian naira became stronger than the dollar. Nigeria was producing 2 million barrels of oil a day. They were getting more dollars. The export was far more than all the things they were importing. So there was no need to do anything with interest rate. They just let it go because the export was making their currency stronger. Now, when it's the other way around, you can decide to shoot the interest rate to heaven, nothing will change. And that's what's happening in Ghana. The fundamentals, and it's unfortunate that the Bank of Ghana will write in its own report that the problem is weak fundamentals. Our fundamentals are weak. So it doesn't matter what we do. Now, the next one is inflation itself. You see, when you have high inflation, what it means is this. It means that the value of the purchasing power of the currency, of the money in your hands, keeps reducing. If inflation year to date is 30%, year to date means that from 1st January to 20th August, if inflation is 30%, or like they say in Ghana, 31.7% officially, it means that the 100 cedis you had in Ghana in January is not the same as the 100 cedis you have now. The value related to the January one, now you have what? 68.3. Because 31.7 has been eroded by inflation. The money in your hand has lost value because of inflation. And when your money loses value as a local currency, of course, it reflects in its relationship to the US dollar, which is the world reserve currency. So the higher the inflation, the weaker your currency. It doesn't matter. You think that you can use interest rate to restrain the inflation. But when you have this hyperinflation like in Ghana, interest rate does not touch it. The next one is public debt. I'll just be very simple here. Public debt, when your debt reaches unsustainable levels, your credit rating goes down, like it's happening in Ghana. And what that means is that investors will start withdrawing money from you because they will not be giving money because they are scared of default. They are scared of it, and that's why international markets have all closed to Ghana. Everybody's scared of default. So then the US dollar that you need becomes acutely important than if the dollars were coming in from investors. So you have issue with supply. Now, when you have issue with supply with increased demand, then the value of the dollar goes very high. And that's where we are. Now, increasing interest rate will not change this reality. The problems we have in Ghana, they are all fiscal problems. Fiscal problems. And the solution is not going to be one big cane from monetary policy. Our fiscal mismanagement is going way beyond what an economy the size of Ghana can sustain and can do anything about. It is terrible. Public debt, you cannot owe to the point of non-sustainability and think that increasing interest rate will make a difference. Now, of course, economic management, political instability, and all those things which take confidence out of a country will all lead to panic withdrawal to safety. And that will lead the country the path Ghana is on now. Sliding currency. Sliding currency. I mean, today, Bloomberg has reported, and I think what they said was that a hawkish surprise raise in interest rate in Ghana may still underwhelm markets. Hawkish surprise rise in interest rate in Ghana may still underwhelm markets. The markets are no mover. In the following story, they actually said that the Bank of Ghana or the Central Bank of Ghana has raised the interest rate by 300 basis points, the highest on record. But that may not be enough. Of course, it's not going to be enough. The fundamentals are wrong. We have deep negative balance of payment problems, deep negative terms of trade with the rest of the world, deep public debt, deep budget deficits. How is interest rate going to correct these things? Everybody has lost confidence in the economy. Investor fright. Investor fright always brings about flight of money, flight of investment from that economy. And the problem is where we are now. We have raised the interest rate by the highest margin on record, 3%. 3%. I've been in Australia for 22 years. It's never been raised by more than 0.5%. 90% of the time, it's raised by 0.25. 10%, 0.5. Not even 1%. We raised it by 3%. Everybody knows that we don't know what we are doing. And of course, The next thing that nullifies everything is supply of money. Now, you have raised interest rates by 3%, but you are printing more money that is not captured in the budget to pay salaries and to do other things in the economy. You are increasing cities, making it cheaper. So we have more cities than we are supplying more cities than the demand for cities is. So it's going to be cheaper, and the value of the city will fall relative to all major currencies. And that's where we are. But they have to print their cities, because in the first quarter, we don't know the second quarter yet. In the first quarter of the year, the debt servicing, the money we used to service our debt was 108% of our total revenue collected. The money we needed to service our debt was more than the money we have collected. So we needed money to even add what we have collected to service the debt. We had to go on our reserves. And that's the Bank of Ghana in the reports I read yesterday said that lots of reserve buffers. We don't have reserve buffers because we're using reserve money in our reserves to add to money to revenue we've collected to go and service debt. So how are you going to pay workers? You got to pay money to pay workers. So we put money to pay workers, we increase money supply in the economy. And you think by raising interest rate, you're going to stop the start with the city when you have so much city that has to be captured in the budget. I mean, there's something fundamentally wrong here. I don't know what I don't know. But look, the guys panic. They don't know what to do. Next slide. Domestic economy. Okay. So now when you increase interest rate, you increase cost of borrowing, and therefore you increase cost of production. When you increase cost of production, what happens? You decrease profit, because either the company is going to pass on the increased cost of production to consumers, or the company will have to absorb that and lose part of its profit. In the stream, businesses will have to close if they cannot handle the cost of production. And when that happens, you have increased unemployment. And when that happens, you have increased crime. When people are thrown out of job and they have to eat, they will resort to crime. So you are not going to use interest rate to stop the sliding city without thinking about what's going to do to the other aspects of the economy. Local business. Local business. And after they raised the interest rate, the city fell even faster. Now it's going beyond 10 cedis to the dollar. So it's not going to work. You are not going to use interest rate to solve what fundamentally is a fiscal problem. It doesn't work like that. The fundamentals are wrong. And this is how domestic economy is affected. Look, we are in for a big turbulence ride, where the guys don't understand what they have to do. They raised 10 points in the document when they met. Honestly speaking, if I were there, going to talk about only 3 points. How to do something about supply of money and to correct the fiscal deficit. But they don't understand it. I'm sorry. When you increase interest rate, you increase cost of borrowing, you increase cost of production, you reduce profit, and it may lead to closure of businesses and increase unemployment and increase crime. It's as simple as that. Next slide. Personal choice. Okay. Personal choice is not very different from business choices. Now, when you increase interest rate and people have to pay more for their mortgage and other things, their credit card or whatever, you are increasing their income effectively. And what that means that they're going to decrease consumption. They have less disposable income, so they're going to be very selective. And that causes distortion in the economy. Because once people are pinned to the wall, then they'll be buying things which are essential, and things like chocolate and things may suffer. It causes distortion in the economy. And some businesses, in fact, it's not just distortion, but it affects distribution of labor and resources and all those, because some parts of the economy which are essential may not suffer so much as those ones which are not so essential, and they may collapse. So we have what I call apartheid economy. Two economies, one favorable or one more favorable than the other because of an insane rate in interest rate. You create an apartheid economy. And those in the favorable area may collapse. As I go to experience in Ghana, a lot of businesses are going to collapse. Businesses that are going for loans to expand may think twice because they have to pay higher interest rates, and there's time to say that they won't even increase it further. The uncertainty in the market is terrible. And those who are going to borrow money to start businesses, we will start because you cannot go and borrow money and pay interest of 40% on it. Because this interest rate, the way I look at this, people, they're going to increase it again. But they don't know what they are doing. I'm sitting here with a cash rate of 1.85, and in my country, in Ghana, it's 22%. So once I'm paying 2.85% on my mortgage, somebody in Ghana on mortgage will pay more than 30%. How is that possible? Well, the person get the freedom to spend and buy other important things. So life is going to be very thin and on the very, very essential, and other part of the economy will collapse. That's how that apartheid economy works or looks like under a regime like what Ghana is having. And of course, investment options. You see, they don't understand how these things affect the various parts of the economy. When somebody knows that if I put money in the bank, I'm going to get 25% for doing nothing. I'm going to get 25%. So then that person will not go to the stock market. Because the stock market always carries some risk. You may not get 25% there. So basically, you may be even collapsing the stock. It's an offshoot of an apartheid economy. Because if people know that if I put my money here, it's risk-free, I'll get this money. They're not going to put money in another area which is risky, and they don't know how much they're going to get. So again, you distort the market. There's no balanced spread of investments. One place is loaded, the other place. But in Ghana's case, it's even more complicated because when you put your money in a bank and you are told that you get 25%, annual 25%, and year to date, inflation is 32% officially. So by the end of the year, inflation could be 50%. And therefore, even your 25% that you get from the bank will be worth nothing. You're losing half to inflation. And that's what happens. So then people who have this money will go back to the market and buy more dollars because there is security in having dollars. And that places pressure on the system again. Demand for dollars goes high, and then the price goes high. So this is what happens when you print money into the system and you cause inflation. These are the problems. And believe you me, interest rate under those conditions will never, ever work. What you have to do, go back to the drawing board, put the fiscal measures in place, stop printing more money, leave cut, what do you call it, live within your means. These are fundamentals. And increase exports and reduce imports to balance, to get a more positive balance of payments. Without doing that, you're wasting everybody's time. Again, when you send panic waves because of stupid monetary policy, those with money in the state will go and buy more dollars. The demand for dollars will skyrocket. And that means that the value of dollar relative to your currency will skyrocket, and your currency will fall further. And that's what has happened since this mad rate increase. Manyaba.
Thank you for that, Dr. Nee. Thank you for that. It's funny, whenever it comes to, I kind of understand what you're sharing, because maths is not my strong suit. But with how you've explained, it's helped me get a little bit of an insight into how things actually work. It's kind of logical as well. This is what I found.
Yeah. It has to be logical. Yeah. That's only that can come from my mind.
Yeah.
Everything is logical in my mind.
Mm-hmm. Logical.
No, it's a very serious thing.
It's a hugely serious thing. It's hugely serious, yeah.
Very, very serious. You see, because as I'm sitting down now, if I have 100,000 cedis in Ghana, I'm not going to put it in treasury bills. Mm-hmm. Because the rate of inflation is moving faster than whatever I can get from treasury bills. Mm-hmm. So if I have 100,000 cedis in Ghana, I'll go and change it to US dollars.
Yeah, that makes more sense.
So I'll have 10,000 US dollars with me. Mm-hmm. Now, taking 10,000 US dollars from the market into my house, when no corresponding 10,000 US dollars has come from anywhere, makes US dollars scarce, therefore more expensive. So the next person who wants to go and buy US dollars may buy it at a higher rate. Mm-hmm. Because it's now $10,000 less, the system. So unless we can get some big money from outside to make up for what I've taken from the system, the city is going to slide. Mm-hmm. As I'm talking to you, only yesterday, I was told by somebody very, very close to Cocoa Board, Ghana Cocoa Board, that our cocoa, which we projected about 1 million metric tons, we harvested only about 600 and something thousand. We are short for by more than a third of cocoa projections. So we're going to fall short about a third of dollars from cocoa sales. And that's what they always do. They use cocoa money to buffer the city. Mm-hmm. We are in big trouble. The cocoa money. Mm-hmm. Go on. The cocoa money. So, for instance, if I go and change 100,000 cedis into $10,000, but then they get cocoa money to replace it, then I have not created artificial shortage. Mm-hmm. Mind you, I'm not the only person going to take 10,000. You are taking 10,000. Kwame is taking 10,000. This way taking 10,000. In a day, we are taking 1 million. If we do not get 1 million from somewhere to replace it, then dollar becomes more scarce and therefore more expensive. That's what's driving the thing. I don't know why they don't understand. And the big buffer that usually comes in November from cocoa is going to slash by a third, because the projection is that they made in the budget way beyond.
Oh, so it was the projection that was way beyond, not that there was some kind of issue with the crops that didn't yield.
Well, I mean, I think for one reason or the other, the crops, what they have sold, what the farmers have sold, and now I'm not discounting the possibility of smuggling to Ivory Coast. Mm-hmm. But what they have harvested and is on record is 600-something thousand metric tons. Now, for listeners, I'm telling you that If that figure is correct, then today, as we speak, Ghana is number 3, Indonesia is number 2. But Indonesia is producing over 800,000 metric tons. If that figure is true, look, we are in big trouble, okay? The cheapest source of money to Ghana government is cocoa. And that's going to be slashed by a third. If that figure I was told yesterday was correct.
So I think I asked this before, but just with what I'm hearing you say, do you think it's there's going to come a time where you're going to have to be reliant on the dollar? The dollar's going to have to be propping up the CD?
You have to do what?
Do you think the time is going to come where the dollar is going to have you propping up the CD? I mean, it's kind of doing it now, but do you think, because I know there was a time, I think in Nigeria as well, like dollars were better to be used as currency as opposed to Naira. Is that happening now in Ghana? Yeah.
No.
Why is that?
No. Okay. The situation we are in now, if I get your question correct, you are asking me whether we can use the dollar as our currency, or what's your question? Let me just get it.
Will it, because of how poorly the CD is what's happening with the CD, how poorly it's performing, will it come a time where you'll have to use dollars for currency instead?
I mean, we are already running a bi-currency economy. Okay, we're already running a bi-currency economy, and that's also part of the problem. Is forced integration. Two different strengths. They are pulling them together. Obviously, the stronger one is pulling the weaker one down. To completely fully dollarize our economy will be difficult, because what it will mean is that salaries will be expressed in dollars, and that can be depressive. If somebody is earning 1,000 cedis a month, and now it comes open that look, he actually earns $100 a month. I don't know how. I don't know. No, we won't get to that point. The city will just keep falling.
Okay, I don't know. If it falls so low that it becomes absolutely worthless, what then?
They will still print more. I don't know. I don't know what's going to happen, because for the first time, though, in the Bank of Ghana, summary I read, for the first time, they did not mention COVID and European war as part of our problems. They talk about weak fundamentals. So obviously, now the rhetoric is changing. They are going to face the reality. The only way that I can see, not even immediately, but in the next probably 6 months, if government has the balls to cut expenditure, to dissolve ministries, do so many things to reduce expenditure. But they are not going to do it. I don't know. I don't believe they are going to do that. And then the only way that they'll be forced to do that is massive uprising. But the way we are going, I don't know. I personally, if you ask me, okay, and I'm saying this to anybody who cares to listen, I can't see this country the way we are going. I can't see Ghana the way it is now by the end of October. I've said it.
So what do you see at the end of October? What do you see at the end of October then?
Well, like I said before, if you a bit of material physics will let you know that every system has got a space that it can float. You call it the elastic limit. You know, it bounces around, it comes back, bounces around, it comes back. Then it gets to a point called the yielding point. The yielding point is that it doesn't bounce back. I believe Ghana is close to a yielding point. And after the yielding point, if more pressure is applied, it gets to a breaking point and it breaks. Like you are stretching an elastic band. When it breaks at that point, there's nothing you can do. Nature will take its course. I cannot see the way things are going. I cannot see Ghana the way it is today at the end of October. I don't know what form it will take. It's not a joke. It's a serious matter. Bloomberg reported today that highest interest, single highest raise in interest rates on record. And it's not going to work. There is no way it's going to work. You come and tell me next week that, you are right. It's not going to work. I mean, if you're not careful, the dollar will hit 12 cedis before the end of the month.
But
the speculation is so right.
But it seems like there's nothing happening in place to try and prevent this anyway. So it's pretty much a certainty that's going to happen, right?
Yeah. Okay, now Bloomberg is saying that investors are waiting, praying that IMF will intervene with $3 billion. You see, when that money comes, then if I take 10,000, you take 10,000, this will take 10,000 from the system, there's replacement, so there's no pressure. But as it is now, every single day people take dollars because they have money. They worry that they are still becoming valueless, so they're taking dollars from the system. The pressure mounts and the city falls. And that's what I'm saying. That if it continues like the way it is now, I don't know what's going to happen 1st November. I honestly don't know. But the way I look at it, and I've been projecting these things from the time budget was read last November. I've been saying these things. Every single thing I've said has happened. Because it's so simple to know what's going to happen next if you are very honest. There's no magic anyway. We are not managing the economy well.
Something from Eric here. He said the cocoa yield late last year and early this year was very poor. I got about 50% yield for that season, and that was all over the country.
So what they told me, Eric is a cocoa farmer.
I didn't know. Okay.
Yes, he's been pulling me into it, but I'm not a farmer. I'm a rich doctor here. I'm joking. Now, on a more serious note, so now somebody very close to Cocoa Board told me this yesterday. Now, I was talking to the person. He said, "Oni, the 1 million is, we are far from that. It's about 6 or something." I said, "Then we are in trouble." So he's confirmed that to me. He got 50%. And so it looks like the whole country is about 6 or 61%. So we are in trouble. A third of the projected income from cocoa is not going to come.
So it looks like Ghana is going to become bankrupt, right? Is that correct?
Yes. Now, if you have read the Bank of Ghana, the Monetary Policy Committee, whatever I read yesterday, the fourth reason, according to them, is loss of reserves buffer. Okay, so we don't know how much is left in reserves, but there is no buffer. They are spending $450 million a month to import fuel. Okay, now 2 months is 900 million. Okay, close to $1 billion. If at the beginning of the year we have 9.7 billion reserves, what have we done so far? So there are no buffers. This is very serious. And not only that, on the 12th of January, they told the whole Ghana, the whole world, that Bank of Ghana was going to pump 150 million. I had this discussion with Eric. $150 million onto the money market to stabilize the city. So add 150 million to 450 million for fuel, 600 million a month. But I know that in January, the money people took from Ghana was $250 million, not 150. So even the Bank of Ghana infusion of money was not covering the withdrawal. So I'm sure they might have increased the infusion to the market to the point that I said, no, let it be whatever it will be, let it be. We can't do it anymore. That's where they are now. That's where the panic is.
So I'm just thinking, like, in terms of a business, like I would do over here, when a business goes bankrupt, sometimes what has to happen is the auditors come in and start selling off their assets to get back the money.
Yeah.
So in a situation where we're dealing with a country,
I'll go and buy Ghana. I'll go and buy the country.
What would happen?
You see, what's going to happen is this. What's going to happen, or what should happen, is for Ghana to go to the lenders and ask for restructuring of the loan of his debt. Okay. Yeah, they have to go and beg and go and beg and go and beg. But you see, the lenders will look at the track record. The lenders will look at what the government is doing in its fiscal space, no monetary space. And government is still spending big, doing big things, building foolish cathedral, doing all these things. I said, look, come on, guys. We are not building cathedrals, and you want money from us to go and build your cathedral. Are you all right? But I'm just really the way it's going, the way it's going, I can't see this cycle going beyond October.
So that's like 2 months.
The president is saying that God should come and turn Ghana around. He's asking God to come and rule. Okay, I'm God's son. Let me come and rule in place of my father. The guy is just a joke, an absolute joke. But he knows what's happening. Yeah.
And he has the power to do something about it, but isn't basically.
He has the power to do something about it, but ego. And the way they lambasted the previous government. So they are stuck. Interest rates is not used for only one thing. It's not used for stabilizing currency. It affects many parts of the economy. And you have to understand that the parts of the economy it affects can undo everything it can do with regards to exchange rate. Can actually collapse the economy. People cannot borrow to invest and reinvest. Wrong policy. Absolutely wrong. Just imagine Eric has borrowed money to do the cocoa farm. Now he's going to pay 3% more to a farm that has given only 50%. What's going to happen? These are the issues. That's why in civilized countries, they don't increase the interest rate by more than 0.5, because you got to monitor how it affects other moving parts of the economy. You got to assess and say, hey, is that the correct thing? Let's do it slowly in case it doesn't work, in case it doesn't stop the inflation and doesn't stop the interest, the exchange rate. We don't hurt industry too much. Let's check and see. Well, if you hurt industry, people lose their job. They don't pay income tax. They are not thinking. They don't pay income tax. You print money then to fill in the income tax gap. And then the city goes again.
Wow.
The understanding that the economy has got many moving parts is what is lacking. And that's what they call in basic economics, what they call it, law of diminishing returns. When you stretch a variable too far, the outcome is diminishing returns. You can only do it within a certain limit where you get the maximum returns. When you go beyond that, it becomes diminishing returns. And that's what's going to happen.
So, I mean, and I keep asking this, like, I don't know what the answer is. So how does the everyday Ghanaian prepare himself for what's coming?
Oh, God day. God day. That's the way they think. Even the president is saying that what is not possible with man is possible with God. God is going to turn Ghana around. That's what he went and told the Presbyterian whatever ministers. Everyone was clapping. Like a big joke. Like a big joke. I mean, balance of payment, right? Balance of payment is current account, actual sale of goods and services, plus capital account, actual investment from outside into the country, or investment into the country. Who is going to invest in the country where at night the whole country is dark, doom, so no light? They can't even go for dinner. They can't go. They don't understand the whole thing.
We've got a comment here from Rashid Sarpong. He says there's got to be some sort of a serious investigation to actually figure out how and where this particular Ghana government screwed and tanked the economy.
That will have to come when the power is taken from this government. That will have to come. It's just unbelievable what is going on. I mean, all over the place, the city hits, the dollar hit 10 cities, the dollar hit 10 cities. Can you imagine our currency? What they are saying is that if Kufu had not taken 4 zeros from our previous cities, by now our currency is 100,000 cities to $1. The weakest currency in the history of mankind. 100,000 units of my currency will give you $1. By now, we're buying bread with money in wheelbarrows. It's a disgrace. Papa Nanipo is politics as usual. Until something hits the fan.
Which
and they will smell it.
Yeah, which it will.
Oh, the way it's going, you know. Yeah, I don't know. I hope something happens to stop it. But the way it's going, IMF is not giving the money until the first quarter of next year. But I'm sure they will send an SOS message to IMF that please, otherwise the country will whatever. The meltdown is real. The meltdown is real. Major balance of payment challenges. And that's where the problem is. The problem shouldn't come from monetary policy. It comes from fiscal policy, fiscal readjustment. They say fiscal consolidation, which is a lie. Okay, read the budget, you know this is a lie. Of course you know it's a lie. Read the budget. Do they think we are children or what? But every day before thief man, one day before master. One day, that one day is coming.
Yeah.
It
says here, Eric has also said here, we also have massive labor shortages on the farms. People prefer going to do galamsey or sell on the streets. So medium and large scale farms are struggling to maintain their farms.
Yeah, you know, we've done so well to downplay agriculture. You've done so well in school. If you do something wrong and they want to punish you, they have to go and weed, because weed is punishment. So we actually left school thinking that anything to do the farm is a form of punishment. So people go there only if they are desperate. If they have the choice, they will never step on the farm. They either go and do galamsey, which is illegal mining, or go and sell on the street, or go and be criminals. Ghana has probably one of the largest arable land in the whole wide world. Even if you put a stone in the ground, it can germinate. But here we are. It's terrible. No leadership to make agriculture attractive. Everybody talking about, oil. What is oil? 2000 and before COVID, Fonterra, a milk company, a dairy company in New Zealand, one company sold 3 billion worth of milk products to China. One company. What do we get from oil? 1.1 billion, 1 billion, or even less, depending on the price of oil. One company to one country, 3 billion. What is oil? And northern region, the northern regions there put together, they form a bigger land than New Zealand. So whatever they can produce in New Zealand in terms of agriculture, in terms of cattle and whatever, we can do it also in the north. But when you say it that way, people think you are insulting them.
Yeah. Yeah.
I don't know what's going on. But if New Zealand comes to give us money, we'll collect both hands. But the money they give us is from farm. It's a disgrace.
It's kind of hard. It's almost like there's nothing to say. There's literally, we're watching something happen. We're just, unfortunately, we have to sit back and watch this thing happen because the people who are steering the vehicle aren't aware or don't care. They're steering into war. So all the passengers are sitting there watching this thing happen.
I mean, when you read the Bible and you read what happened under Saul, you wonder, what were they thinking? But it's happening right in front of us. We need a David. We need a David. We need a David. It's happening right in front of us. We become a laughing stock. Bloomberg is writing about Ghana for all the wrong reasons. Every day. There's got to be a change. A David must come. And Saul fell on his own sword. Whoever is in charge must fall on his own sword.
Yeah.
Because this is not acceptable.
Yeah. Yeah. Because it's less than 60 days to the end of October, isn't it?
Yeah.
No, it's about 60 days. About 60 days.
Yeah, a bit more than 60 days. About 70 days or thereabout.
Yeah. So
we'll
that's
see what's going to happen.
Time that's the only time for something to turn around. Something's got to shift within that time.
Yeah. Because
that's pretty scary.
I mean, they held an extraordinary meeting. Monetary Policy Committee of Bank of Ghana had an extraordinary meeting, and they brought a 10-point laughable point. Laughable point. I mean, I read about these things 8 months ago. Laughable. I mean, I'm not an economist. I don't even know anything about economics. Just trying to figure things out. And just being honest.
Well, there are no more questions, Dr. Nee. There are no more questions. I think it's kind of sad to end it on that kind of a note. Oh, 1 second. One more just come in. Dr. Darker, how best do we efficiently capture and broaden the tax base? What tools could be employed to do this?
Oh, very, well, I don't want to say very easy, but relatively easy. Oh, that will take another 10, 15 minutes. I think we'll talk about taxation next week. Let's do it that way. Yeah. How to broaden the tax base. You see, because we are looking at two broad things: direct tax and indirect tax. Okay. Now, which is easier to grab and which is morally right to implement? It's very easy to go indirect, like you can increase VAT. Very easy. Because of the nature of it. You put on everything, so people have to pay. But it's immoral because indirect taxes are generally flat taxes. They affect the poor and the rich the same way. Actually, it affects the poor more because if I pay 10% of my 1,000 cedis, the effect is not as bad as somebody paying 10% of his or 100 cedis. So, whereas indirect tax is easy, it affects the poor more. Direct taxes, you can target. In Australia, 60% of all income tax is paid by the top 5%. 60% of all income tax is paid by the top 5%. Is targeted. Okay. Now, total revenue in Australia, 48% of total revenue is from income tax. Almost 50% is from income tax. So if top 5% pay 60%, it means that the top 5% they pay 30% of all revenue in Australia. What about Ghana? Top 5% they pay 60% of all income tax. Total revenue, they pay 47%, 48% of total revenue is from personal income tax. Or let's say 50% from personal income tax. So those who pay 60% of this 50%, they pay 30% of total revenue in Australia. Yes, and I'm sure it's similar in Britain. When Ken Oforiatta started this e-levy thing, he actually opened his mouth and said 60,000 doctors, lawyers, accountants, professionals do not pay their tax. In Australia, these are the people that pay 60%. In Ghana, they don't pay tax. So for him, the solution is to impose an indirect tax like e-levy, an immoral tax. That's what I'm saying. So talking about tax, you have to look at what is immoral, what is moral versus what is easy. And I always go the moral way. We'll talk about that next week.
Okay. All right, and Dr. Nee, there are no more questions, and we've gone over an hour, so I think this is a good place to wrap up. Thank you to everybody who's joined us. Thank you to everybody who got your questions in. Much appreciated. It's always good to hear what your thoughts are, so Dr. Nee can speak to those, and it also adds like a good, good conversation point for these particular broadcasts. Thank you very much for that. As always, we'll be back same time, same place next week. As always, let people know about this channel. Let people know about the sorts of things that we've been talking about. Go back and look at some of its older broadcasts so you can see what the conversation has been up until this time. And also, don't forget to purchase the books. I put the question up there, but it seems like no one's purchased them or you didn't see the question. Get on his Book Nook store and take advantage of the books. So you can really start to see and understand how his mind works and why he thinks the way he thinks with regards to Ghana. Okay, so please make use of those. Avail yourself of those. Avail yourself of his writings on his website, which I mentioned earlier. If you'll just join us for the first time, his website is sankofaafrica.com. And these are all of his social media handles and platforms. But please do make yourself familiar with his platforms, with his writings, with his books, so that you can go at the same pace. You can understand why he thinks the way he thinks, and let other people know about this as well. Spread the message far and wide. Okay. So that's it from us for today. Thank you for joining us. As ever, we'll see you next week. Let everybody know. Join us again. Take care. Bye-bye.
Bye, everyone.